Goldman Sachs just reported its second-best quarter in company history. Net revenues hit $17.2 billion. Net earnings reached $5.6 billion. Earnings per share came in at $17.55, the second highest ever recorded by the firm. Return on equity was nearly 20%. By every conventional measure, this was a triumph. The stock fell 2.9% on the day. That is not a rounding error. Goldman was the worst performer in the Dow Jones Industrial Average on Monday. While the broader S&P 500 clawed back to positive territory for the year, recovering from a sharp morning sell-off triggered by Trump's announcement of a naval blockade of the Strait of Hormuz, Goldman Sachs drifted lower even as the index recovered. The surface narrative had already been set by the geopolitical shock. Oil crossed $100 per barrel after the U.S. Navy moved to blockade all ships entering and exiting Iranian ports, effective 10 a.m. Monday. Equity markets opened down sharply. Then a midday report from the New York Post, citing a Pakistani analyst, suggested Iranian officials were internally studying whether to accept a U.S. condition to abandon uranium enrichment. Markets snapped back. The S&P 500, which had started the year underwater, briefly turned positive. Energy stocks soared. Goldman's investment bank posted record global banking and markets revenues of $12.7 billion, with advisory revenues up 89%. The answer sits inside Goldman's own earnings call. David Solomon noted that advisory revenues surged on the back of higher completed M&A volumes. Goldman's fixed income, currency, and commodity trading revenues, the segment that typically drives outsized gains during geopolitical volatility, came in below expectations. The firm's FICC business, which should have been the direct beneficiary of a $100 oil spike and a Hormuz blockade, missed. Goldman earned brilliantly through deal completions that were signed before the Iran war escalated. It did not capture the volatility premium from the war itself. That distinction matters for forward expectations. Goldman's advisory backlog is built on deals that were announced during a period of relative geopolitical calm. As the Hormuz blockade stretches, corporate boards freeze merger timelines. The pipeline that produced $1.5 billion in advisory revenue this quarter is unlikely to refill at the same pace under current conditions. UBS left its rating unchanged at neutral with a $930 price target, noting that Goldman's EPS beat was largely driven by tax effects rather than business outperformance. There is a second layer. Goldman's equity underwriting revenues rose 45% year-over-year to $535 million on deal completions, but new equity issuance in a $100 oil war premium environment slows almost immediately. The revenues Goldman booked Monday reflect a world that existed 90 days ago. The revenues Goldman will book next quarter reflect the world that exists right now. And right now, the Strait of Hormuz is blockaded. Ceasefire talks in Islamabad collapsed over the weekend, and Iran has not accepted the uranium enrichment condition. The 19.8% return on equity that investors celebrated this morning is already a historical artifact. Intel posted its ninth consecutive day of gains Monday, up 56% over the streak and extending the most sustained rally for the chip company since at least the 1970s. Goldman's investment bank helped finance many of the AI infrastructure deals that drove Intel's re-rating, but the bank itself sold off while those deals appreciated around it. That asymmetry is the day's defining financial moment.
The key question is whether Goldman's Q1 performance represents a durable step-up in earning power, or whether it was the last clean quarter before geopolitical risk reprices the deal pipeline. BlackRock upgraded U.S. equities on Monday, citing resilient earnings and what it called contained Middle East risks. That framing assumes the blockade remains a negotiating tool rather than a sustained military posture. If Iranian officials do accept the uranium enrichment condition, and the midday New York Post report, however contested, did move markets sharply, the M&A environment could reflate quickly. Goldman's advisory backlog would re-accelerate. The stock sell-on-news reaction would look like an entry point. If the blockade extends into a second week, oil supply disruption becomes structural. The last tankers carrying Iranian oil were already en route to refineries on Monday, according to the Financial Times. Once that supply reaches its destination, the physical market tightens with no equivalent replacement. Goldman's FICC revenues could outperform in Q2 on raw commodity volatility, but its M&A business would compress, and equity underwriting would slow further. The net effect is probably negative for Goldman's full-year earnings trajectory, even in the upside scenario for oil trading. The weight of evidence leans toward the second outcome holding through at least mid-quarter. Goldman stock has already priced a structurally better business. What it has not priced is a world where the deal pipeline drains faster than it refills. The earnings beat is real. The forward assumption embedded in Monday's sell-off is also real. The one number to watch, Goldman's next M&A advisory completion announcement.
If Goldman confirms a significant deal closing in Q2 that was signed before the Iran war escalated, the stock has a credible path back toward $950. If the announcement stream goes quiet into May, the sell-off was correct. The Q1 record stands either way. The question is whether it was a ceiling or a floor.